A storm is brewing in the American economy, and this time the warning signs are coming from Wall Street. They're coming from Walmart. Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. And our show today, for decades, Walmart has been a symbol of American affordability, but today they become a harbinger of economic doom. What did they say that has everyone on the edge? As you're about to see, the truth is more frightening than you think. Plus, you could be missing out on life-changing profits. The proof Bank of America's hottest trade of the year was a slam dunk for our subscribers using our proven momentum strategies. Stay tuned to the end of the show to learn how you too can make big money trading momentum, just like our subscribers. Now, let's head over to Bloomberg, where we picked today's story by the headline, as Walmart profit forecasts fall short on slowing growth. And this is something we've been warning about. We've been talking about how inflation is running too hot and that income growth isn't keeping up, and this is causing demand to plunge. Walmart now warning that a storm for the American economy is clearly now on the horizon. On a call with analyst John Rainey, the company's chief financial officer described its guidance as consistent with past years, but noted there are still uncertainties related to consumer behavior and global economic and geopolitical conditions. Now, it's obvious he's talking about the tariffs when he's talking about global economic and geopolitical issues, but when he's talking about the consumer here, this is important to understand, he mentions that there are uncertainties related to their behavior. Now, we shouldn't be seeing uncertainties if the economy is experiencing a soft landing. What we should be seeing is an increase in demand, an increase in foot traffic, an increase in order size. Everything should be consistent that the economy is turning around. But what he's suggesting that things for the U.S. consumer is getting worse, something we've been talking about, and the evidence now is getting very clear. For the upcoming year, Walmart expects overall net sales growth in the range of 3 to 4%. Now, keep in mind, that's not inflation adjusted. So you start to knock inflation off that number and you get something less than 2%. That's not a good sign for Walmart. And here's the bigger issue. We haven't had reporting yet from other retailers. Well, if Walmart is struggling and seeing signs it's going to get worse, just wait till everyone else tells you the state of the consumer. We're going to find out it's far worse than everyone wants to believe. And that's lower than the 5% growth the company experienced last fiscal quarter, which makes perfect sense because the economy was better in the last fiscal quarter. And we know during the end of the year, consumers were front running the tariffs. Now we're finding out the reality. Income growth isn't there. The labor market is starting to weaken. And all that means is consumer demand is coming down. And that for retailers is the worst possible sign. Let's take a look at consumer price index. This is shown in blue against real retail sales. That is shown in red, both on a year-over-year rate change. And let's go back to the late 1990s. And what do we see? That the consumer price index is rising, and well, rather rapidly. At the same time, what do we note that happens with incomes? They start to slow down and peak, and that has an immediate impact on real retail sales. You can see here around 1999, they peaked and then decelerated all the way into a contraction that morphed into the dot-com bubble. As we move forward to 2006, we see the same trend. Inflation shoots higher, but we know wages didn't keep pace. That had, again, an immediate impact on real retail sales as consumers had to pare back their spending to deal with higher prices. Sure enough, that caused real retail sales to decelerate, enter a contraction, and we headed right into the global financial crisis. And let's look at where we're at now. We've seen nearly 3 years of negative real retail sales, many saying that the end of the year was the turnaround, that demand was going to surge higher. We said no, that was all due to tariff front running. What are we seeing in the data from the manufacturing sector here in the U.S.? Inflation rising. What are we hearing from China? That they're potentially devaluing their currency. That would cause inflation in the U.S. to go up. How about tariffs? Yes, it's going to have an impact. So we can expect now prices to go up. And what does that mean for real retail sales? They're likely now to head down. That's exactly what Walmart is telling us is coming. And Rainey said in an interview that the guidance doesn't include the potential impact of tariffs given the unpredictability around the levies. Walmart imports food from Mexico and general merchandise products like microwaves from China. And we'll work with our suppliers. We'll lean into our private brands to keep prices low, and that the company has operated with tariffs for several years. Now, what he's telling us here is that consumers are trading down because he wouldn't be focused on their house brand, which everybody knows comes in at a very low price point, if that wasn't what consumers wanted. So he knows there's financial stress. The households are having to adjust their budgets, cut their spending, looking to their household brands. Walmart is telling us very clearly that things for the American consumer and the American household budget are getting worse and fast. The retailer, known for low prices, has benefited in recent years from consumers prioritizing essentials like groceries following years of inflation. The most recent quarter, the company said it saw growth in the market share primarily from households earning more than $100,000 a year. Now, this is interesting because what he's telling us is low-income consumers cannot afford these increases in rent and energy and food and still spend on the discretionary side of the economy. Meanwhile, higher prices are also impacting higher income households who are now trading down to Walmart in a bigger way. Now, what's notable is they're not going into the stores. What they're doing is they're ordering for pickup or on the app. They're doing everything they can to save a few bucks. But something that should be putting money in your pocket is our momentum trading system. Let's check out Bank of America's biggest trade this year. That was in Brazil as of close of business yesterday. It's up nearly 11%. And here you can see back on the 16th, this was the note we gave our subscribers. Now, many people struggle trading momentum indicators because they look at every overbought scenario and they try to buy, but they're missing one big component, and that is the trend. We've changed the game on this. We've made a revamp to our Momentum Timer Pro Report. Stay tuned to the end of the show because if you want to make big money trading momentum, well, we're going to show you the way. Check out the links in the description below. Grab those coupon codes for a free 30-day free trial because I would describe the consumer as steady, Rainey says, and the spending is far from a complete rebound. Well, that's obvious. There is no rebound. What we're seeing is demand decline from consumer spending into the end of the year to front run the tariffs. He notes general merchandise sales are improving and demand from holiday season is in line with what the company expected, but he notes that the consumer is steady. You note that he's not saying that they're improving, and there's a good reason why that we're seeing this. Let's take a look at this next chart as we now overlay incomes, which is in the form of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That in blue against real retail sales in red, both again on a year-over-year rate of change. And let's go back to the 1990s. We talked about what happened to total incomes is they rallied up and then peaked and decelerated. What happened? That marked the near-term peak of real retail sales as incomes go down and inflation went up. Households had to cut their spending, and sure enough, that sent us right into the dot-com bubble. We see that in 2006. Incomes went up, but inflation went up faster as income growth started to peak and roll over. Retail sales took a hit as they both decelerated. We went right into the global financial crisis, and we almost had a double dip recession around 2010 into 2011. It was very clear income growth peaked and decelerated in a big way, but retail sales didn't take such a big impact. Is what saved the day. And look at where we're at now. Walmart talks about how consumers are steady. It's very clear because income growth is flatlined, but we're about to see inflation head higher. The risk is consumers will not be able to afford it. Demand will come down, and for retailers, they're telling us very clearly a storm is on the horizon. And Walmart, the first big box retailer to report quarterly figures after the holiday season, saw its stock plunge 6%. The company's results just came a few days after data showed a slump in retail sales, which we completely predicted would happen, and that indicated an abrupt pullback by consumers after a spending spree in the closing months of 2024, which was very obvious. We look back and it's clear consumers saw tariffs coming. They wanted to buy ahead of it, and now all of a sudden they're changing their tune. They're starting to pay down their credit cards. They're starting to increase their savings, and that comes at a massive sacrifice into retail sales. And this does have an impact on the equity markets. Let's take a look at total incomes, still shown in blue, now overlaid against the NASDAQ 100. And what do we see as we go into the dot-com bubble? As income growth decelerates, well, stocks eventually start to come down. It makes perfect sense. As inflation grips household budgets, they have less money to invest. In some cases, look to sell their investments to make ends meet. And next thing you know, stocks and demand come plunging down. We see the same thing happen going into the global financial crisis. It almost happened when we saw a double dip recession. Incomes went down. You can see the stock market choked, rallied, choked again. We saw it happen around 2015 into 2016. And now look, investors say the market can only go up and is going to surge higher. Meanwhile, income growth is down, plateauing. It's likely to head even lower because if Walmart says demand's going down, this is going to backfeed right into the manufacturing sector. There's going to be a lack of new orders. We know hours worked are going to get cut, more jobs are going to get cut, and at the same time, we're going to see that flow through to the services sector as we typically do with about a 3-month lag. And consumers are really going to get sticker shock in the next few months if these tariffs become a reality. Coupled with the insurance crisis in California, coupled with gas prices, eggs are still $12 a dozen in some places. That is, if you can find them. And coupled with some of the rising costs on the consumer index, we're hitting a tipping point, and consumers can only take so much. And that is something we've been warning about, that we are facing an inflection point where consumers say, look, I know prices are going up. My income's not keeping pace. I can't afford it. I've got this massive amount of debt that I've built up at high interest rates. Insurance and other costs are rising. Something must give. And that's going to be the discretionary side of the economy. And that means it's going to lead right to more job losses. And the evidence of that is clear as U.S. jobless claims now tick up slightly, right in line with pre-COVID levels. Now, this is very interesting because initial claims increased by a mere 5,000 to 219,000 in the week ending February 15th. But normally that number is relatively low historically, but that's not the number we've been concerned about. We've been watching continued unemployment claims because what happens in the beginning of a year, there's a lot of people that lose their job for seasonal reasons, but then the economy starts to absorb them and we see that number come down. There's a big problem. It's not coming down. Continued claims are proxy for the number of people receiving benefits increased to 1.87 million in the week ending February 8th, indicating the economy is not creating jobs. And this is a huge problem because when we look at continued claims in blue against initial claims in red, we see very clearly where continued claims go. Initial claims eventually follow. You can see that going into the dot-com bubble, once again going into the global financial crisis. And look now, continued claims rose, plateaued a little bit, rose again, plateaued, rose, and now they're plateauing a little bit. Initial claims down, but that's not going to last for long because if these people that have been on unemployment for an extended period of time do not re-enter the workforce and prices go up, that means their spending is going to go down even more because, again, they don't see a big increase in their unemployment checks just because inflation rises, demand goes down. That means, again, other people see their hours worked get cuts and even some see a job loss. Nationwide, initial claims have been generally consistent with levels seen in 2019, supporting the Federal Reserve's intention to keep interest rates on hold until inflation progress resumes. And based on what we're seeing, the direction in inflation, well, the Fed's going to be on pause for a while. Well, at least that is until they start cutting again into rising inflation. You heard that here first. It's going to happen. That said, some high-profile companies like Metre and Southwest Airlines have said they plan to reduce staff, and that is into an economy that does not have jobs for all of these workers. That remains a huge problem, and you can see why Walmart's talking about a storm on the horizon. As you take a look now at continued claims against real retail sales, that in red on a year-over-year rate of change, and you can see very clearly in early 2000, as initial claims went up, that was the inflection point. Real retail sales come crumbling down right into the recession. We see that happen again. When we talk about inflection points, you can see it in the continued claims data right there in late 2007. They started to head up. There's no looking back. Real retail sales crash right into a global financial crisis. And here we are again, continued claims not heading down. There is an inflection point when they break to the upside. And when that happens, it's game over for the U.S. economy. And let's take a look at Hasbro because they see a return to growth and $1 billion in savings by 2027. And we're going to start hearing more of this from companies saying, look, we're turning things around. We think things are going to get better. And how are we going to do it? We're going to cut our spending. Now, keep in mind, when companies cut spending, that means income and revenue to other companies goes down, and that backfeeds into the labor market. As demand for toys has slowed after a pandemic boom, Hasbro and rival Metre, the maker of Barbie and Hot Wheels, have sought to eliminate costs and focus on profitability, and that means cut spending. Services sector will take an impact. That also means employees are going to see their hours worked get cut. You're going to see these companies restructure all of their labor. You're going to see people hit the unemployment line. And will the Fed do anything? That's the ultimate question. Is the Fed seeing all this and say, hey, you know what, we need to react? Nope. Not a chance. Fed minutes reveal little appetite for near-term rate cuts because right now the Fed's fixated on inflation despite the fact they can't see that we're heading into a stagflationary recession, one that's going to send millions of Americans on the unemployment line. The majority of participants observed that current high degree of uncertainty made it appropriate for the committee to take careful approach in considering additional adjustments to the stance of monetary policy. This is an issue because they can't see the forest from the trees. There's a big problem. The economy is slowing down. down. They're fixated on inflation because they don't want to cut rates. What's going to happen when we hit that inflection point and the labor market starts to unwind, you're going to watch the Fed change their tune immediately and start focusing on the real economy. But by that point, it's too little, too late. And even business contacts in a number of districts have indicated that firms would attempt to pass on to consumers higher input costs arising from potential tariffs. What that means, we already know consumers cannot afford these higher prices. These costs are not going to be passed on. What we're going to see is inventory hit shelves and start to get stuck there. As demand goes down, that's going to lead to fewer new orders. Manufacturing sector is going to lay off, and that's going to then impact the services sector. So you can see where we started the show, Walmart clearly saying a storm is on the horizon, but it doesn't mean you can't make money despite the coming storm. Check this out, because when it comes to trading momentum, well, we just do it better. Here you can see our Brazil trade up 10.64%. Now, how did we do that? Well, check this out, because we have a 71% win rate right now. 14 open trades on our Momentum Time Pro Report. 10 are up. This is huge. And we told our subscribers to buy right here, and now it's headed higher and looking to break out again. But a lot of people trade these momentum signals like the RSI and the MACD, and they think, hey, you got to oversold levels, I should buy. And the problem is oversold levels lead to price going down, and then price going down again, and then going down once again. They're missing one key component. My friends, that's why we run a proprietary overlay on all of our indicators, to give you the edge to put more money and make it easier for you to trade momentum. Now, you get the report, but you don't even have to read it, because right underneath the report every day, we tell you which trades we think you should take. But you get the report, you get the signals, you get my opinion on all the trades, you get full back tested data, risk control levels, a weekly update, my personal trading account. I tell you exactly what I'm trading, and on top of that, because we know you can make money trading our system, we give you a 30-day free trial, because we want to see you putting money in your pocket before you pay us a dime. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.